Disclaimer: the following forward-dated report is for informational and news analysis purposes only. It does not constitute legal, financial, medical, or official advice. All content is presented as news and commentary, not as guidance. No anecdotal story here should be treated as advice. July 5, 2026, Corporate Treasury's new mission: CFOs turn cash into rocket fuel. High-yield era spurs tech-driven liquidity revolution. Corporate treasury and cash flow management. A quiet revolution is underway in the corporate finance universe as CFOs of major e-commerce and tech giants increasingly harness high interest rates and new financial technology to transform cash management. After years of rock-bottom interest rates, today's yield-rich environment has thrust corporate cash holdings back into the spotlight, turning vast cash reserves from idle balances into strategic assets. CFOs are seizing this moment by turbocharging liquidity management, sharpening cash flow forecasts to near real-time precision, and actively shifting surplus cash into higher-yield, short-term investments. This mission control approach to liquidity means every spare dollar is put to work, with companies treating cash reserves as the rocket fuel for their next phase of growth, rather than leaving it languishing at near-zero returns. Global e-commerce leaders are leveraging this strategy aggressively, aiming to insulate their balance sheets from future turbulence while fueling expansion, an optimistic, futuristic twist for an industry once grounded by the constraints of dead cash. At the heart of this paradigm shift is an embrace of technology, particularly AI-driven treasury platforms and integrated fintech partnerships, enabling unprecedented autopilot cash management. A headline partnership in June saw New York fintech Ramp join forces with AI investment platform Moment to integrate institutional-grade fixed-income investing directly into corporate finance workflows. This smart treasury collaboration allows even mid-sized companies to automatically sweep excess cash into professionally managed bond portfolios in a matter of minutes, a process that once took dedicated teams weeks of manual effort. Such innovations close the gap between everyday corporate finance and high-end asset management. CFOs, in effect, are equipping their finance departments with digital co-pilots, employing machine learning models to forecast cash needs, optimize working capital, and allocate funds to maximize returns without missing a beat. As CFOs experiment with these intelligent systems, they are mindful to fortify internal controls, strengthening oversight, and aligning with audit requirements so that automated decisions remain transparent and compliant. By pairing algorithms with human stewardship, companies are striking the balance between agile, tech-empowered liquidity moves and prudent governance in a complex regulatory environment.
Prosphäre.
+1. Meanwhile, some treasurers are quietly expanding their toolkit by exploring digital dollars, like stablecoins, for specialized use cases, from 24/7 intergroup transfers to supplier payments in far-flung markets. With clearer rules emerging, the U.S. Genius Act of 2025 and Europe's new MiCA regulation have established firm guardrails for stablecoins. CFOs are cautiously piloting blockchain-based instruments to move funds seamlessly across time zones and borders. These experiments remain modest in scale, reflecting a careful approach to compliance and risk management. Any stablecoin trial must stand up to rigorous audit scrutiny and legal standards. Still, just a year after global retailers like Amazon and Walmart were reported to be considering launching their own stablecoins for faster settlements, more mainstream companies are acknowledging that digital currency, once seen as a fringe curiosity, may soon become a practical treasury tool. In this new era, corporate treasurers are preparing for a future where liquidity management verges on the interplanetary, with cash sloshing at the speed of light in a global, 24/7 financial system, while ensuring legal compliance and safety remain mission-critical to avoid any missteps as the final frontier of finance is explored. Convera. +1. July 5, 2026, ERM 2.0, risk management goes on offense, from compliance checklists to AI-enhanced Guardian systems. Enterprise risk management, Facing an unpredictable world, companies are fundamentally rethinking enterprise risk management in 2026, adopting more proactive and technology-driven frameworks to manage an expanding universe of threats. In a major development, the influential COSO organization released new guidance on May 4, 2026, aimed at moving risk management from documentation to action, underscoring a pressing need for firms to translate risk assessments into rapid, decisive responses. This reflects mounting boardroom urgency. After a string of recent corporate stumbles, from cyber attacks to supply chain disruptions, chief risk officers and CFOs are taking the offense on risk rather than just defensively checking boxes. Today's top risks, from cyber threats and AI failures to climate shocks and regulatory shifts, have become as complex and fast-changing as a meteor shower, forcing companies to strengthen resilience like never before. A recent global executive survey shows cyber attacks remain the #1 near-term risk prioritized by board members and CFOs alike, followed closely by third-party vulnerabilities and the dangers and promise of rapid AI adoption. In a volatile market environment, risk management has evolved from a back-office compliance function into a strategic, investor-critical competency. The stock market is increasingly rewarding companies that demonstrate agile risk mitigation and strong governance, while punishing those blindsided by foreseeable threats. +1. To fortify against this onslaught of new-age hazards, organizations are deploying advanced technologies that make risk management more dynamic and predictive. Artificial intelligence and big data analytics have been enlisted as the new guardians of enterprise stability, scanning for early warning signals and modeling what-if scenarios at machine speed. Some companies are using generative AI to stress test their operations for black swan events, identifying vulnerabilities far beyond human foresight. Simultaneously, cybersecurity frameworks are being elevated, with zero-trust architectures and extended detection and response systems becoming standard risk controls to counter increasingly sophisticated ransomware and supply chain hacks for global e-commerce platforms and financial institutions. The push for integrated risk intelligence is also transforming corporate culture. Chief risk officers now collaborate closely with CIOs and data scientists, ensuring risk insights are embedded into product development, financial planning, and strategy execution from the ground up. The aim is not just to mitigate harm, but to see around corners, to turn risk management into a competitive advantage and a catalyst for innovation in an environment where the only constant is change. Legislators and regulators, too, are reshaping the risk landscape with heightened expectations and new rules. Governments around the world are drafting AI governance laws and ESG risk disclosure mandates. From the European Union's new AI Act and sustainability reporting requirements to U.S. agencies signaling stricter oversight of technology-related risks. This wave of regulation is compelling enterprises to beef up their risk frameworks around everything from data privacy and AI model biases to climate resilience and supply chain transparency. Board audit and risk committees now face legal obligations to demonstrate robust risk oversight, a trend emphasized by recent SEC proposals that would obligate companies to disclose how they manage climate risks and cyber threats. In response, companies are leaning on RegTech solutions to ensure compliance and traceability of risk decisions, transforming risk reporting from static spreadsheets into dynamic, real-time dashboards that can be shared with regulators and stakeholders alike. It's an era of hopeful vigilance. Corporate leaders are optimistic that technology can help them not only survive the gauntlet of emerging risks, but also turn it into an opportunity, an audacious voyage beyond uncertainty into sustainable growth. Next-Gen Insight. +1. July 5, 2026. Real-time rails and digital currencies reshape B2B payments. Global commerce races toward a multi-rail future. B2B payments and infrastructure fintech. The world of B2B payments is hurtling toward real-time, borderless efficiency as global financial infrastructure enters a new age of interconnectivity. In a milestone for international commerce, a consortium of major central banks and payment networks is linking domestic instant payment systems across borders, turning yesterday's multi-day wire transfers into near-instant transactions. The European Union's instant euro payment mandate, with regulators now requiring euro transfers to settle in seconds around the clock at no extra cost, has set the pace for change. While in Asia and the Americas, new regional networks are being bridged to allow companies to send funds across countries as easily as texts. For multinational e-commerce marketplaces and manufacturers dependent on fast supplier payments, the ability to move money 24/7 is a game changer. Shipments of goods can depart from Shenzhen or Rotterdam knowing payments will clear virtually in real time, reducing working capital lockups and supply delays. As the G20's 2027 deadline for lowering global payment costs and times looms, what was once an aspirational dream of frictionless cross-border commerce is now a concrete roadmap. Businesses that treat these changes as a mere compliance exercise risk falling behind more visionary competitors embracing payments transformation as a driver of growth and resilience. Convera. +1. Convera. Several converging trends are driving this infrastructure leap in 2026. ISO 20022, a new global messaging standard for payments, is now fully in effect and pushing financial institutions to upgrade their systems with richer data, including standardized address information that improves anti-money laundering, AML, checks and fraud detection through AI screening. Meanwhile, traditional hubs like SWIFT have rolled out next-generation protocols in collaboration with dozens of major banks, promising end-to-end payment tracking, upfront fee transparency, and near-instant settlement in corridors where domestic instant systems exist. The result is a multi-rail payment ecosystem. Companies can now select the fastest, most cost-effective route for each transaction, whether through a bank's network, an online platform, or a digital asset rail, based on the specific corridor and context. Payments experts note that in e-commerce and remittances, small businesses are leading the charge, turning to fintech providers that can seamlessly route transfers across local real-time networks or even crypto networks, capturing faster settlements and lower fees. Global B2B payment volumes are surging, particularly among small exporters and digital marketplaces, which are growing at double-digit rates as they tap into these new highways of commerce. Convera. +1. Perhaps the most striking sign of the times is the mainstreaming of digital currencies and stablecoins in B2B flows, enabled by newfound regulatory clarity across key markets. Regulators have laid down clearer rules for fiat-backed stablecoins. The U.S. has introduced a federal stablecoin oversight law that ensures dollar-pegged tokens are fully reserved and supervised by banking regulators, while Europe's MiCA framework now licenses crypto asset providers under stringent transparency and reserve standards. These regulatory green lights, combined with cost and speed advantages, means stablecoins have quickly evolved from an interesting experiment to a serious option for enterprise payments. More companies are now considering stablecoins for tasks like just-in-time local payouts to vendors in cash-strapped regions and settling marketplace transactions that span time zones. Cross-border payments technology has entered a golden age, where once businesses were constrained by the gravity of slow, costly wire transfers, they are now empowered with a constellation of cutting-edge options, from instant bank rails to blockchain tokens, for an era of planetary-scale e-commerce. The challenge ahead lies in navigating compliance across jurisdictions and integrating these multiple rails seamlessly. But the course is set. B2B payments are well on their way to a future as fast, transparent, and ubiquitous as a satellite signal circling the globe. Convera. +1. Convera. July 5, 2026. RegTech Renaissance. Compliance goes on autopilot. AI and automation race to outpace regulators. RegTech, regulatory technology. A compliance tech boom is unfolding in financial services as firms respond to the twin pressures of rising enforcement risks and mounting regulatory complexity in the digital age. The past year has seen an unprecedented spike in regulatory crackdowns. In one recent case, The U.S. Treasury's FinCEN levied a record $80 million fine on a prominent broker-dealer in March 2026, the largest ever for a securities firm's anti-money laundering failures. That penalty capped a wave of global enforcement actions as watchdogs from Washington to London signaled zero tolerance for compliance lapses, especially those involving cryptocurrency, sanctions violations, and data breaches. Banks and fintech startups alike have learned that outdated manual processes and understaffed compliance teams can no longer keep pace with 21st-century financial crime. As one prominent regulator described a recent enforcement as a wake-up call demanding smarter controls, the message to the industry is clear: invest in next-generation RegTech or face severe consequences. AML Network. +1. AML Network. Companies have responded by supercharging their compliance capabilities with AI and automation, sparking nothing short of a RegTech renaissance. Using machine learning algorithms and natural language processing, banks and fintech platforms are now automating everything from real-time transaction monitoring and risk scoring to KYC identity verification and regulatory reporting. These smart compliance systems can sift through vast volumes of transactions and communications, flagging suspicious patterns, sanction hits, or policy deviations in seconds, 24/7, far beyond any human team's capacity. Notably, global financial institutions are deploying AI to parse new regulations and ensure they are up to date on requirements across multiple jurisdictions, a necessity as cross-border digital business grows. The cost of compliance has been skyrocketing with each new rule, from GDPR-style data protection laws to advanced cybersecurity mandates, pushing CFOs and chief risk officers to treat RegTech not as a luxury, but as core risk infrastructure that pays off by preventing multi-million-dollar fines and reputational damage. Indeed, in a recent survey, a solid majority of bank executives indicated that RegTech solutions are now a top investment priority for 2026, expected to yield benefits in efficiency and risk reduction far outweighing their cost. A striking turnaround from a decade ago when compliance tech was often underfunded. Asterisk legal and regulatory developments are directly feeding this explosion in compliance technology. Governments are coordinating on stricter, tech-informed oversight, with the EU's Digital Operational Resilience Act, DORA, demanding robust IT risk management capabilities across banks by 2025, and U.S. authorities stepping up scrutiny of fintech operations and crypto-asset firms. In Asia, regulators are embracing subtech supervisory tech to monitor financial institutions in real time, essentially expecting firms to have matching RegTech gear to interface with these digital supervisors. This symbiotic push has spurred creative solutions. For example, blockchain-based compliance ledgers now enable verifiable tracking of transactions and smart contracts for audit-ready transparency, addressing concerns like trade provenance and anti-fraud measures in e-commerce marketplaces. And in the U.S., after years of discussion, the SEC's new electronic communications record-keeping rule, prompted by large fines for banks whose traders used unauthorized messaging apps, has forced Wall Street firms to adopt encryption-compliant messaging platforms and AI tools that automatically archive and analyze communications to detect insider risks. The thrilling promise for businesses is that these technologies can transform compliance from a cost center into a high-tech shield, an automated defense grid protecting the enterprise while letting innovation and global commerce proceed at full throttle. The era of compliance by design is here, with RegTech enabling even small startups to operate with big bank levels of control, and companies of all sizes embracing a futuristic, proactive approach to meeting the law before regulators come knocking. July 5, 2026, Markets Without Borders. Trading enters a new orbit. Day traders get green light as exchanges embrace next-gen tech. Institutional trading and market infrastructure. Global market infrastructure is undergoing a bold upgrade, making stock trading faster, more inclusive, and ready for a high-tech future. In a historic regulatory shift, U.S. financial regulators have eliminated the decades-old pattern day trader rule, a post-dot-com era restriction that required at least $25,000 in an account for frequent stock trading. Effective June 4, 2026, the SEC-approved FINRA rule change replaces the old barrier with real-time intraday margin standards, allowing traders with accounts as small as $2,000 to execute unlimited day trades as long as they maintain risk-based margin coverage during the day. This long-sought reform, phased in through 2027 so brokers can implement dynamic margin monitoring systems, has been celebrated as democratizing market access. Online trading platforms that cater to younger, lower-balance investors stand to gain from a surge in activity. Robinhood, for example, expects a boost in transaction volumes and revenue now that millions more retail traders can orbit the markets freely without being grounded by the $25,000 rule. Industry leaders, who have lobbied for this change, hail it as overdue modernization aligning rules with today's highly liquid, tech-driven markets. Still, regulators stress the importance of new risk controls to prevent reckless leverage, requiring brokers to closely track customers' intraday exposures and ensure adequate collateral, a safety mechanism to guard against excessive speculation even as the gates to active trading swing open wide. AOL. +1. Exchanges and market operators, meanwhile, are embracing cutting-edge technologies to modernize trading and settlement, further transforming the institutional landscape. With U.S. equities already transitioning to T+1 next-day settlement and discussions of near-instant T+0 settlement on the horizon, attention has turned to how innovations like distributed ledger technology, DLT, can remove remaining frictions in trade clearing. In Europe, regulators have built on their pioneering 2023 DLT pilot regime, proposing reforms to expand the sandbox program's scope and scale for tokenized securities trading. By eliminating caps on tokenized asset volumes and inviting more participants, potentially including licensed crypto asset service providers, CASPs, the EU's planned DLT Pilot 2.0 aims to unlock mainstream adoption of blockchain-based settlement while maintaining strict investor protections. These moves reflect a broader global trend, from the New York Stock Exchange's experiments with AI-driven trading surveillance to Asia's 24/7 digital exchanges exploring cross-border connectivity. Market infrastructure is preparing for a round-the-clock, tech-augmented paradigm. As they upgrade, trading venues and clearinghouses are also tightening legal and compliance safeguards, embedding smart contract audits, algorithm accountability checks, and resilience tests to satisfy regulators that speed won't undermine stability. The final frontier of finance is coming into view, a world where trades settle at warp speed and investor access extends to more people than ever, all underpinned by advanced tech and collaborative regulation. Market insiders see a hopeful path ahead, one where broad participation and innovation flourish hand-in-hand with robust oversight across the global trading cosmos. Taylor Wessing. +1. Video description, SEO-friendly. In this forward-looking financial news report, July 5, 2026, we explore 5 hot stories shaping the future of money and markets. Corporate Treasury leads off as CFOs of e-commerce and tech giants harness high interest rates, AI, and even digital currencies to supercharge cash flow management. Next, we delve into enterprise risk management, ERM, where boards and risk officers elevate their strategies with new frameworks and AI tools to navigate cybersecurity threats, regulatory shifts, and other emerging risks. Our third story examines B2B payments and fintech infrastructure, from the global linking of real-time payment rails to the adoption of stablecoins for cross-border business transactions. We then report on a RegTech renaissance, how companies are leveraging AI and automation to transform compliance and prevent massive fines in an era of aggressive regulators. Finally, we highlight institutional trading and market infrastructure, including a historic U.S. rule change opening day trading to more investors and the integration of blockchain and stock exchanges for lightning-fast settlements. Don't miss these in-depth analyses of how cutting-edge financial technology, regulation, and innovation are converging to drive the next era of global markets, with a hopeful eye on what lies ahead. Disclaimer: this video is for information only and not legal, financial, or official advice. Tags: Finance News, Corporate Treasury, Cash Flow Management, CFO, high interest rates, liquidity strategy, financial technology, fintech, artificial intelligence, enterprise risk management, risk mitigation, cybersecurity, B2B payments, cross-border transactions, real-time payments, stablecoins, regtech, compliance, AML, market infrastructure, stock trading, day trading, cryptocurrency regulation, blockchain, fintech innovation, e-commerce, global economy, future of finance. Base thumbnail concept: a dynamic collage blending 5 finance scenes, a CFO at a futuristic control panel, symbolizing AI-driven treasury, a shield icon over data streams, risk management and cybersecurity, a globe with currency symbols orbiting, cross-border payments, a gavel next to a circuit board, regtech and compliance, and a rocket launching from a stock market chart, trading innovation. Bold text overlay reads Future Finance, 5 big stories, and the date, capturing the forward-looking, space-age theme with a professional, tech-savvy aesthetic. Thumbnail variation A, focus on tech and cash, a close-up of a business executive in a suit, illuminated by digital financial data holograms and a stack of coins morphing into a rocket. Overlaid title text, Tomorrow's Finance Today, with the date, highlighting innovation in corporate treasury and fintech. Thumbnail variation B, focus on global payments, a 3D globe connected by neon payment network lines, with currency icons, dollar, euro, crypto tokens, and a speedometer graphic indicating real-time velocity. Title text, Global Money at Light Speed, July 5, 2026, to emphasize the cross-border payments revolution. Thumbnail variation C, focus on market and risk, a stylized stock market board set against a starry space background, with a scales of justice icon hovering to represent regulatory oversight. Title text in bold, Markets Launch into the Future, followed by the date, conveying a blend of optimism, technological progress, and strong governance.